Hi, Shay Russell here from ABC Bullion, and joining me today from the other side of the world is John Butler, contributor, consultant, and author in the gold space. Now, John, you're no stranger to ABC Bullion. So, in spite of the fact that you and I have actually spoken before on the Hard Money Council, which is for subscribers of a UK newsletter service, you have been a speaker and presenter at Australia's Gold Conference, of which ABC Bullion has been fortunate to be a sponsor of.
Yes, indeed. I've been there several times, and it's always been a great pleasure.
Well, it might be a couple of years before we get to have you back, but we've got some pretty hard borders in place in Australia at the moment. Now, I want to kick off. Now, you've probably covered this topic quite some time, a few times in your extensive experience in talking about the gold markets. But I want to start first and foremost with the most obvious question, and that is, why invest in gold? Why invest in precious metals? Why should we encourage people to put money in none other than a shiny rock?
Well, it's interesting you asked that question because, in fact, a lot of people I feel get distracted when it comes to such an essential topic, and they get distracted by the latest trend, the latest fad, the latest speculation, the latest whatever it is. It might be chart or technical analysis, say. And the thing is this: is that like anything else in the world, gold, of course, it can be traded. You can just try to trade it for a fast buck. But really, if you look at the history of gold and the role that gold has played and someday may continue to play in the international financial and monetary system, gold actually provides a very, very different function, a very different purpose than just being a speculative tool, as anything can be. Gold is money. And what is meant by that is more than just the usual definition of money, which has been largely scrubbed from the history books. Money is not merely a unit of account. It's not merely a medium of exchange. It absolutely positively has to be a robust, reliable, long-term store of value, something that fiat currency still really hasn't proven. And in fact, if anything, it's kind of losing credibility as we go through the years post Bretton Woods, etc. The other thing I'd mention, though, is that money also is a final form of settlement of debt, the ultimate final form of settlement of debt. Why is that important? And why is that not normally included in the definition of money when people talk about it? Because it makes them very uncomfortable. The fact is, we currently have a debt-backed monetary system, but debt and money are not the same thing. Debt is originated, but only repaid and extinguished in exchange for money. Gold serves that purpose. And what that means is that you need to own gold as part of a portfolio if that portfolio is to survive the increasingly probable restructuring or devaluation or default of some portion of the world's existing debt burden, which everyone knows is essentially unserviceable without resort to one of those three options. So gold is absolutely essential as part of a portfolio, regardless of whether one thinks the price is going up or down today or tomorrow.
Now, you and I are talking after a little bit of a dubious anniversary, and that is the 50th anniversary of Richard Nixon ending the gold standard. Now, tell me, since you wrote your most recent book, The Gold Revolution Revisited, and obviously since Richard Nixon has taken the US dollar off the gold standard, what has changed? And does this increase the urgency for investors to own physical gold?
Well, Nixon's move was one of a series of moves, really. Don't get me wrong. He deserves, all of the opprobrium that he receives for that decision. But really, he was kind of left with no choice in the matter following many years of the U.S. spending more money than it could reasonably, repay without resort to reneging on the Bretton Woods agreement. So Nixon was in a tough place, but he made a decision which arguably he didn't have to make, and so he does deserve, his share of the blame. But the point is this: is that the global financial system is now completely unanchored more so than at any time since it was sewn together in the first place in the 19th century. Gold and silver circulated as money for the bulk of recorded history for a good reason. That is, whenever two tribes, two nations, two whatevers wanted to trade with each other, but couldn't necessarily agree the specific terms of legal arrangements between them, they always chose to settle their respective trade in gold and silver and edged out everything else. These comparisons with seashells and carob seeds and everything else that has served as money, they don't answer that question, why gold and silver always won. Always. And there's a reason for that, which has to do, of course, with their resilient nature. In any event, today, we're in a situation where the system is completely unanchored. It is the greatest monetary experiment in history. Those referring to Bitcoin or cryptocurrency or blockchain more generally as a form of alternative money or a monetary experiment, they should glance across, of course, at what's been happening since Nixon closed the gold window, inaugurating by far the greatest monetary experiment in history, one that does not appear to be working out very well. And so the reason why gold's role today remains so important, notwithstanding that official demonetization, is because it's the ultimate form of insurance for investors. It's the ultimate form of money. It's what is going to backstop the system when we go through some sort of reform, reset, restructuring, devaluation, default. Some mix of the above is inevitable. It could kick off tomorrow. It might not kick off for 5 or 10 years. Who knows how long? But if you don't have a certain portion of gold in your portfolio, it's not truly diversified and prepared for the risks that lie ahead.
So I'm glad you touched on a couple of those topics in there. So let's talk about how investors' attitudes towards precious metals have changed. Now, obviously, we've touched on, the big investors starting out. Now I want to move on to what you're seeing with your institutional and high net worth clients, particularly in the UK. Now, Australia, we could argue, in spite of the country being littered with gold, we don't really have a large investor take up of owning precious metals. Now, with your clients and the people you consult for in the UK, are you seeing their attitudes change in how they shift their portfolios to precious metals?
I've seen several changes in recent years. Let's go back to 2008. 2008 and 2009, that is the global financial crisis, scared a lot of people. There were many people who literally never had considered adding gold to their portfolio, who actually realized at that time that the global financial system was dangerously unstable, that both stocks and bonds could decline very dramatically in value, currencies might be devalued significantly, etc. And so they added in some gold for the first time ever. That's true of institutions, that's true of individuals. However, at the same time, I had many conversations with people in the aftermath of that crisis who said they were considering adding gold or precious metals generally to their portfolios, to their investment processes, but they didn't. They didn't, but they made a note of it, as it were. And there's something in our mentality, once bitten, twice shy. The thing, though, is this: when something happens twice, it's no longer a coincidence, it's no longer an accident. I feel that there is a very large number of institutions and individuals who came close to accumulating a material amount of gold or other precious metals back then, who, if they saw another big disruption, would absolutely positively do so, because they would no longer regard 2008 and 9 as an aberration. And that, I believe, reaches all the way into the mainstream. That's your 12th monkey sort of point in this, to use an analogy out of Hollywood and literature. That is, that you reach a critical mass of people who start talking to their friends, their family, and so on and so forth. And before you know it, literally everyone is talking about gold. Everyone's accumulating at least a little bit. Now, because the supply of gold is basically fixed, if you shift the demand function for gold in that psychological way, there's no way for supply to respond. It's just not possible. And so the only way for that market to clear is for the price to rise. And again, because the supply is essentially fixed, if that shift in the demand function is sufficiently large, the price rises by an literally inestimable amount of magnitude. It's an extremely nonlinear function at that point. And the price of gold that clears that market could be 10 times higher than what it is today.
Speaking of prices upsetting the market, let's talk about the flash crash. Now, gold rarely moves nearly 8% in at the tail end of the trading session, at the start of a trading session. So I don't want to get into the technical weeds of what the price has done. But what I did notice is that this flash crash sort of entered the mainstream consciousness. And a couple of editorial reports have said that, oh no, there's only down for gold here. There was one UBS report reported earlier in the week that it's bad news for gold ahead. Given that these are what the average retail investor is reading, how can we help them fight that psychology and argue against that mainstream narrative?
Yes, that was a very odd event. And it leaves a lot of people who are familiar with the gold market scratching their heads, because the gold market is actually an extremely large and liquid market. And it rarely goes through wild swings like that. That said, it does on occasion. You can look back at the entire post-Bretton Woods history, which is roughly 50 years now. And the biggest two-day decline in gold ever was 11%. So to have an 8% intraday swing like that is historically significant. However, let's place that historical significance in context. That swing occurred at the very start of trading in Asia, when gold's liquidity is notoriously the absolute lowest it can possibly be. It is if there's a time when any serious investor or trader wants to move a large amount of gold, be it to accumulate or to sell, that's the last time you would choose to do it if you were trying to get best execution for that order. And so it looks very curious. It looks to me like it's market manipulation. And there have been accusations of market manipulation in precious metals from time to time through the years. Some of those are currently going through the courts, right? There are several large banks that were caught out in recent years manipulating the precious metals markets in ways that, I guess made them at least some marginal profit. But that's the thing, is that if you're an investor and you're trying to manipulate a market so you can take advantage of it, that's what you do, right? You go in when liquidity is poor, you try to slam the price higher or lower. You then take the opposite side slowly over the next few trading sessions, days, weeks, and hopefully make a profit by doing so. And it is curious, of course, gold's already recovered that loss. So if somebody was responsible for slamming it down a week ago, it's over a week ago now. If someone's responsible for that, if they were cleverly in the background reaccumulating that position, they've now made money. Now, regulators don't like that sort of thing. They don't like markets being manipulated that way. And indeed, there have been official investigations into precious metals manipulation in recent years. And who knows, maybe this one will be investigated and maybe we'll learn something interesting.
I like your take on that one. Now, let's put our lens squarely on the US market and a lot of the data that's coming out. Now, I know through our work on the Hard Money Trader Council, we've had this conversation before with each other about the data we're seeing. Now, the Fed is steadfast in their attitude that it is transitory data. What can we tell the public when it comes to us analyzing the data? Is it really that 2020 wasn't a normal year and that 2021 is reflecting the unexpected leaps in the reflation trade and the US economy opening up? Or is the inflation genie, so to speak, out of the bottle and getting away from the Fed, and gold is just lagging, reacting to that?
I think this whole transitory inflation narrative was flawed from the beginning. First of all, the very people who started using that term are the same ones who never predicted inflation rising significantly in the first place. So they don't really have the credibility that they think they have to comment on the topic. Some of us looked at the COVID shock very early on. I published my first piece on COVID's likely impact on inflation already in March of 2020. And I said, this is going to lead to an inflation spike. And I explained why. So the fact is that COVID's a supply shock. You're shutting down all kinds of logistical functions, supply lines, productive processes, et cetera, et cetera. It's very disruptive, started in China, spread all over the world. Okay, so you have a negative supply shock, but on the other hand, governments are trying to offset that by sending stimulus checks around and throwing money at everything. Guess what? A la Milton Friedman, right? If you have, less supply but more demand, you're going to have higher prices. That's economics 101. And why mainstream economists didn't see that coming is, it's bizarre. It's just bizarre. they're either so ignorant of basic economics, which is hard to believe, or they had a different agenda the whole time to control the narrative, which is much easier to believe, certainly in this day and age. So now they're saying, oh, but it's transitory. Well, first of all, okay, fine. They're saying there were these base effects. Yes, the base effects they didn't actually see coming. However, you now have multiple months of month over month seasonally adjusted data that is still coming in above their expectations. So, I mean, how many strikes before you're out? I mean, what game are we playing? So I don't take these people seriously anymore, and investors should be very skeptical. Now, that does not mean inflation just rises forever and nothing goes in a straight line. Fine. But look, we're running at over 5% year over year in the US. And the dollar, that is the US and the dollar, is the single most important inflation rate benchmark for the world. If it hasn't showed up in your backyard, it will very soon. And it will be more persistent than the so-called experts claim. They've been wrong all along, and I think they're wrong now.
So what we could argue is that that basically they're trying to talk the numbers down to not spook the market.
Well, of course, right. Central bankers have been into this so-called jawboning for many, many years now. Once upon a time, when the big, the gravitas central banks, such as the Fed or the Bundesbank or the Bank of England or the Bank of Japan, once upon a time when they did something with monetary policy, they didn't even announce it. They just did it. All of a sudden, interest rates went up, and traders all of a sudden had to deal with it. Nowadays, it's all this, right? I mean, it's like Harry and Meghan. It's all narrative. It's all spin. There's no substance anymore. How often do they actually move interest rates anymore? They don't. They've been at zero for how many years? Anyway, we live in a very different regime now. It's all about narrative. And so every time they open their mouths, you need to understand or at least consider what's the real agenda here.
Do you actually think the fact that the Fed have to talk to the market really exposes how fragile these markets are?
Certainly that's part of it. I think the Fed's doing two things. They're doing one thing in public and one thing in private. I think they're very, very good at preparing the so-called SIFIs, strategically or systematically important financial institutions. They're very good at preparing them for any possible changes in policy. That's done in private, it's done in meetings, it's done over the phone. They then have this very other narrative that they share with the general public, which is sort of their general thoughts to reassure households and small businesses and whatnot. But it's two very different things that they're doing. And so if you really want to know what's going to happen, the official angle is probably not particularly helpful. But if you do have, a connection or a hotline to the Federal Reserve or other central banks, and you can speak to them directly, you might actually get good information. But sadly, it's not available to most people.
Now, we're going to jump a little bit to a different topic, but it's a hot topic right now, and that is the unfolding chaos in Afghanistan. Now, obviously, I'm not a geopolitical expert, so I'm not proclaiming to be, but you did mention off camera before that there is actually a precious metals link to the unfolding troubles in Afghanistan and gold. Can you elaborate a little bit on this for me?
Yeah, I mean, look, this could be a very long discussion. I'll keep it as brief as I can. Basically, they call Afghanistan the graveyard of empires, but something else regarding empires is that as a general rule, when they are in decline, they tend to resort to debasing their currency at some point, right? I mean, the Romans did it. Even before the Romans, the Athenians had to do it at one point, although that was brief. But the Romans, really, showed the world how it was done. And then the Bourbons in France and whatever. There's so many examples here, right? But the fact is that the dollar, as we already discussed, the dollar became unanchored from anything 50 years ago. And the U.S. has been effectively printing money to try and finance its empire. And it is an empire, right? It might be a semi-benign empire, although one wonders sometimes. But certainly Afghanistan is an important signpost in this regard. It's very different than Vietnam because, oddly enough, Vietnam was a tactical retreat by the United States. They still retained effective control of Southeast Asia. They still had by far the largest non-domestic military presence in Southeast Asia. Leaving Afghanistan is very different because you're surrounded by other great powers. Afghanistan is surrounded, look at the map, it's surrounded by, well, Russia. I mean, obviously, you have the Central Asian republics, but Russia traditionally, that's their sphere of influence. You then have China and Mongolia, and then you have India very close by also. The US is leaving what is historically a very symbolic place. And really, what this does, in my mind, is it cements what I think is the reality that the United States is in imperial decline and will continue to resort to devaluation of its currency as necessary to try and stem and manage that decline as best it can. But there's a nonlinear element to this now. Leave the history aside. The fact is that the United States has clearly lost influence in the world. It clearly has lost credibility by getting out of Afghanistan in a way that is very, very messy. And by extension, I do believe that will lead the world to question to what extent the United States is prepared to honor its obligations through its financial assets that are held throughout the world. What is to stop the U.S. imposing sanctions? What is to stop the U.S. Reducing or limiting or ending coupon payments on its treasury debt held by various other actors around the world? Who are you going to believe now that the U.S. has surprised the whole world with this very, very sauve qui peut evacuation of Afghanistan? So I do think it's a big dollar negative, and other factors equal, that's a big gold positive.
So that's fantastic to hear. So basically, this disorderly exit is questioning the narrative that the US is the dominant power, and it's showing a weak spot in either US strategy or potentially how the US would respond to other events of this nature.
Absolutely, absolutely. And just again, to draw the historical analogy again, Great Britain left Afghanistan a couple decades prior to the end of the 19th century. Oddly enough, economic historians believe that it's right around the same time that Britain lost its economic supremacy vis-a-vis the United States and Germany, which was industrializing very rapidly at the time. So oddly enough, Britain's exit from Afghanistan corresponds to its economic decline vis-a-vis its big rivals that would come to play very dominant roles in the 20th century. And you could argue a similar thing is happening with the United States now. And of course, Britain's sterling lost reserve status just a couple of decades after Britain's withdrawal from Afghanistan. So one wonders what that implies for the dollar today.
Oh, that's incredible timing. I shouldn't say I'm looking forward to seeing it, how it unfolds, but I am interested in how that does unravel. Now, we've almost run out of time today. However, one thing I just wanted to draw on a little bit is that you hinted that you have some interesting fintech projects underway where you're working with precious metals. Are you in any position where you can talk about how old money is going to meet new money?
Well, this is the thing, right? Money itself is a technology, if you think about it. It makes large societies possible because you have this medium of exchange that allows people to trade with a very, very large number of other people, household businesses in a very efficient way. And having that circulating medium is absolutely essential for civilization to scale beyond basic Stone Age tribal organization. So gold and silver have served that purpose for the bulk of recorded history, as discussed earlier. But there's no reason why a technology such as money cannot occasionally be advanced and upgraded and modified in various ways. And so I do work with multiple fintech companies to apply modern financial technology to underlying gold and silver as ultimate money and stores of value, to make gold and silver more easily accessible and available and tradable and usable. Why not, right? I mean, credit cards and now smartphones and various apps and are used as ways to facilitate payments. That said, the money's bad, right? It's the bad fiat money that is being undermined by poor policy. Why not use the same technology and apply it to the best money we know, gold and silver? So I'm involved in that.
That sounds fantastic. All right. So just before we wrap up today, tell me, how can everybody find you? Should they be following you on Twitter? Should they be signing up to Macro Hive? What's the best way for people to access your insights?
Well, MacroHive is a subscription service, and it is aimed primarily at institutional investors. So if you'd like to access that, fine, go to macrohive.com. Alternatively, if you simply would like my rambling thoughts and comments on these and other topics now and again, actually Twitter is not a bad place to find me. And my Twitter handle is Butler Gold Revo. The Gold Revo part being an abbreviation of my book, Butler being my last name, and feel free to follow me.
All right. And I'm going to close out today with one statement from you. Tell me, what is something every new investor should know about gold?
Gold is the anchor to a portfolio of financial assets. There are times in history when financial assets, stocks, bonds, you name it, everything, decline in value for reasons beyond our control. Gold is the ultimate insurance against that. No portfolio is complete without a significant holding of gold, which I would place at around 15 to 20% of a liquid portfolio.
Well, John, thank you very much for that. And I hope you have a lovely day over there in the UK.
Thank you, Shay.